Welcome to the video. Today we are going to be covering deferred income. We are going to be covering a definition, how we use it, and I'm also going to give you a use for deferred income which not many people and accountants know about, so be sure to stick around to the end to find out. I'm going to try and keep this really short and concise, as my aim for this video is to just give you a really quick reference as to how to use deferred income and what it is without having to sift through hours of footage to try and find the bit that you need to know. Deferred income, also known as prepaid income, describes services and/or goods that have been invoiced for but not yet provided. So let's run through this. Services and/or goods that have been invoiced essentially relates to you raising an invoice for service or goods. Now, the double entry for invoicing for service and goods is you credit your income and you debit your accounts receivable, which is just an asset that shows all of the invoices that you're yet to receive payment for. This should sound quite familiar if you've watched my debits and credits video. If you haven't, I'm going to link it in the description below, and I'm also going to link it in the corner of the video. Not yet provided is the key part of this definition, as it means that we cannot just credit income and leave it there. As we haven't provided the service or goods yet, we need to defer this to the period in which we actually provide the service and goods. To do this, we simply remove the income. As we initially credited income, we will now need to debit it to remove it, and simply credit the other side to deferred income. This is really similar to prepayments, as we've got an invoice that we can't recognise in the P&L until the period in which it relates. If you're not familiar with accruals and prepayments, then I suggest you watch my accruals and prepayments video. Again, I'm going to link it in the description and in the corner, whichever way it comes up. To understand why we need to use deferred income, then I'd also suggest checking out the accruals basis accounting video. Again, I'm going to link it all so that you can refer to it when you need to. I'm not going to cover the why in this video because obviously I've already done a video on it, but just so that you're aware, that's available for you if you need it. I've kind of explained how we use it when I was going through the definition, but just to give you a bit more value for your time, I'm going to give you an example of how to use it. So in our example, you're a property management company and you own a building which you rent out to a business. You charge them their rent in advance. Today's date is the 31st of December 2019. You've raised an invoice for the period January 20 to March 20. And the invoice is for £30,000. Now, what we want to do here is in December, we want to recognise the invoice posting. Now, our debit and our credit for a normal invoice would be debit our accounts receivable and credit our revenue. But because it relates to January 20 to March 20, we can't recognise revenue because we haven't delivered that service yet. So instead of hitting our income, we hit our deferred income. So the full 30k goes to deferred income as a credit, and the debit goes to accounts receivable. Now moving on to January 20, we now want to start recognising that revenue in the months that it relates. So 1 month of that 30k is going to be 10k, so we want to recognise revenue of 10k. So what do? We reverse out 10k from our deferred income. So we've brought forward the 30k, we debit 10k, and then in our revenue, we credit 10k. So now our new balance for our deferred income is 20k because 30k credit and a 10k debit equals a balance of 20k. So moving on to February, we do the exact same. You can see that we're going to start reducing our deferred income. So again, we reverse out of our deferred income, our new balance of 20k this time from January. We debit our deferred income for February's portion and credit our revenue. Now, the 20k debit credit and a 10k debit means our new balance is now 10k. And then finally, we hit March, which is the last period that our invoice relates to. We then reverse out the last of our deferred income, which again is £10,000. That's our balance brought forward. We debit our 10k here. Now, a 10k debit and 10k credit means we now have a zero balance on our deferred income, and the credit side of this transaction is revenue. So we credit 10k revenue. So now you can see that we've got our invoice posting here. So from the date of our invoice was raised, we can see that we've got an asset as a receivable that we owed this money. And then in our accounts, we can see that we've got 10k for January, 10k for February, and 10k for March. And our deferred income at the end of the period is zero. So this is the need to knows of deferred income, but as promised at the beginning of the video, I'm going to give you a very unknown use for deferred income, which not many people or accountants know. Have you ever wondered when you get a gift card or redeemable points, how the company would account for this? Obviously they can't recognise income because they haven't given you a product or service, but essentially have your money that you've put on the gift card. So how do you account for it? The only place that this money can go when you put it onto a gift card is into their deferred income. And then when you redeem the points or you use the gift card, they then move it out of deferred income and into their income. Now, not many people are going to find this interesting, but I'd like to think if you're watching this video, it's either because you're trying to learn about accountancy or you're interested in it. So I thought that you'd like that. Quite a lot of the time when I go to shops or I'm out and about, I always think of how you'd account for it. If I go to the butchers, I think about how they account for the meat, you know, or if you go to a car dealership, do they count the cars as assets because a car is really expensive, or does it go in their inventory? But that's just the excitement that goes on in my head. Anyway, if you enjoyed the video, please give it a like and subscribe, and any questions, drop them in the comments, and I will see you on the next one.